Hi, I'm Takoa De Silva with Sprott Global Resource Investments, and I'm sitting down here today with Rick Rule, Chairman of Sprott U.S. Holdings. Rick, as always, good to see you.
My pleasure, Takoa. Thank you for initiating this.
Yeah, it's a pleasure. So what I'd like to start out by asking you about here today is this ongoing conversation we've had over about the last year on issuer capitulation. For the person watching, what is that? What does it mean, and what's the climate of that conversation in the resource market right now?
Capitulation is a very dramatic event. It's when most participants in the market give up completely and simultaneously. In my experience, I've been through 3 of them before. There are 2 or 3 week periods with very violent volatility, but mostly on the downside. Mostly it's a situation where the few remaining buyers that have carried a market give up, and the sellers begin to bail out at all cost. Things that contribute to capitulations, because they're irrational activities, could be things like the simple fact of the calendar month of October has witnessed so many down cycles before. The apparent end of quantitative easing might scare people. The idea that they need to get out before impending tax loss sales. What marks capitulations, first of all, is their extraordinary violence, their relatively short duration, and the fact that they're emotionally driven rather than arithmetically driven events. What's useful about capitulations is that in my experience they have marked definitively the end of long bear markets. Markets turn from bad to good as a consequence of markets outperforming expectation, and capitulation dooms expectation. At the end of a capitulation period, the only outlook for the market is bad. And as a consequence, by definition, it's almost impossible for the market not to outperform. That's been the case of every prior capitulation. The other utility of a capitulation for me is that the capitulation becomes broad-based. It extends not only to speculators, but also to officers and directors of junior mining companies. And if we are going to go into a capitulation period now, if past is prologue, what will happen is that the issuers will finally lose hope of raising money in a higher market. They'll go ahead and raise the money that they need now, and they'll begin the process of exploring their properties. You cannot save your way to prosperity in this business. You can only make money by investing money in exploration and development. For 18 months, the issuers have played chicken with the market, waiting to raise more money until the share prices went higher, and as a consequence generated no value that would cause the share prices to go higher. The hallmark in particular of the 2000 capitulation was to bring the very best issuers in the junior resource markets, the Robert Friedlands, the Bob Quartermains, the Ross Beatties, the Lucas Lundins, back to market to say, let's go, let's raise money, let's build.
So the issuer, that's either the person or the management team in charge of running the junior mining company, and you're approaching them, we at this point are approaching them saying, here's some financing to continue your operations, exploration, or take a deposit into production. Is that how that works? And what is the most common objection are you receiving from these teams? Is there a cycle of objections that you see them going through?
Correct. We've probably, as an institution, Sprott, approached 36 junior explorers or developers in the last 12 months. And said, we think that it's time for you to advance your project more aggressively. We have faith in you, we like your property. And the issuers have said uniformly, thank you for your faith. We can't raise money at this price. This price is too cheap. At this price, we dilute our existing holders too much. While we think that's admirable in one regard, the issuers need to remember that this is a capital-intensive business. If you have no capital, you have no business, because they have no income. And what happens as a consequence of not raising money is that the only money that they spend is on general and administrative expense, which means, in effect, they cannibalize their business and they generate their own dilution.
Rick, we had a meeting here in our offices the other day, and you said something really interesting, and I think it has to do with regard to the past 2 months, the news stories that have been surfacing amid cascading downward prices of the precious metals, commodities, as well as the equities. And you said that what we see on the news, if I understood it correctly, it doesn't matter that much, and things that are more relevant to our investments are things like cash flow and discounted net present value of an asset and so forth. I'm wondering if you can talk to that concept.
Takoa, I think you would agree with me that most of the major media, the news that you see on the major media, isn't really issue-oriented. It's become entertainment when the local nightly news in San Diego focuses on a cat stuck up a tree, a human interest story, as opposed to some stories that are real with regards to San Diego. It tells you something about the utility of watching the nightly news. And that extends, of course, to the financial news. People are interested in the big picture, but people make money in investments at the firm level. People make money in investing by understanding events that are intrinsic to the company that they intend to invest in. Certainly your expectation of the future colors the way that you value a company's investments. As an example, if you were of an opinion that the gold price is going to rise, you might be more generous with regards to valuing a gold company's resource and reserve than would otherwise be the case. What happens to people who focus too slavishly on the news is that in effect they disarm themselves. They take themselves away from, as an example, examining the cash needs and the cash generating capabilities of a company and focusing more on things parenthetically, like a cat stuck up a tree.
Rick, what would you say in this market here now with precious metals where they are and the equities where they are, what would you say is the biggest advantage that one could experience by considering the investment in today's market? And also, along with that, what would you say is the biggest risk?
Takoa, we have hammered, when I say we, I mean Sprott, have hammered on our clients for 20 years to understand that natural resource-based businesses are extraordinarily cyclical and extraordinarily volatile. The most important thing that you can understand in today's context is that you have to be a contrarian or you will be a victim. The emotions that you're feeling with regards to your investments are shared by all of your competitors, and right now they're negative, which is to say that your competitors are not showing up to make investments in out-of-favor sectors. The way that you make money investing is by buying low and selling high. Selling high presupposed that you buy low. When is it most possible to buy low? When all of your competitors are scared to death, which is a different way of saying right now. Can it go lower? Of course it can go lower. But what's the probability that the downside materially outweighs the upside? Nil, from my point of view. Conversely, the biggest risk? Easy. For every investor, the biggest risk is not Obama. It's not the central banks. It's not the big thinkers of the world. It's not even Congress. The biggest risk to each individual investor is conveniently located to the left of the right ear and to the right of the left ear. Almost everybody's worst wounds are self-inflicted. Allowing your emotion, allowing your experience in the immediate past to overly influence your expectation of the future will cause you to dismiss arithmetic and replace it with prejudice, which is where most people conspire to lose the most money.
Rick, you've taught me a lot about the cyclical nature of natural resources, commodities. And I'd like to ask you here now, what gives you the confidence and conviction that we will have another upcycle in natural resources? And also, along with that, when you think back on history, how far does that cycle go?
Well, my own experience goes back to the early 1970s. So sadly, that experience is long indeed. Confidence in resource markets can be as broad as confidence in the ascent of man, the longest running bull market in recorded history, because of course we recorded it. Despite the ups and downs, over time society increases its standard of material well-being. And simultaneously with that, society increases its size. We're at 7 billion and counting. There's more people coming on Earth every day, and they all want to eat, Takoa. That's at the broadest set of circumstances. It's odd to me that resource investors, perhaps because of the hard money origins of many of them, believe that a catastrophic decline will be the best possible outcome in the resource business. That's wrong. The best possible outcome in the resource business would be a boom, which increases utilization of commodities in the first hand, and secondly, increases savings, because gold is an important part of the savings matrix of many of the people on Earth. Hence, the more wealth is generated, the more demand for gold is part of the savings matrix. And I believe that the set of circumstances which is in front of us is severe but survivable. I went through the down cycle in the 1970s, and it was certainly dramatic. Interest rates in the double digits, civil insurrection, a generational change in the United States, the Vietnam War, all of those types of things. The situation that we have in front of us is certainly probably no better than that, but probably no worse either. And the outcome of that is that the laws of supply and demand, the laws of the market, will ultimately prevail over the headlines. And the truth is that the stuff, the material stuff of humans will always do well. People will always want to eat. They'll always want to eat more. Just look at me. They will always want access to electricity or something better, which will require coal, it'll require nuclear, it'll require copper. As people, particularly people in frontier and emerging markets, acquire more wealth, they'll require more savings products. And an important part of the savings matrix, as an example, in places like China and South Asia, India, Pakistan, places like that, is gold. So ironically, an increase in living standards would probably be better for gold investors than a decrease in living standards. And while I expect that the time that we have in front of us is turbulent, I suspect that resource investors will do very well, in particular Toccoa, because we're starting from such a low base. Think about the TSXV. Think about an index that's off by 80% in nominal terms. And I say nominal terms because the TSX throws out the worst companies. They throw out the people who failed. In real terms, this is a market that's down by 85%. And that is arithmetically a market that is simultaneously 85% risky and 85% more attractive.
On the subject of gold there, Rick, we had the chance to visit a conference recently, the New Orleans Investment Conference, and great show. In attendance was Alan Greenspan, as our viewers know, an early proponent of gold. I'd like to ask, what were your thoughts there, your takeaway from his comments there, and also his comment on gold?
Dr. Greenspan, pardon me, was very, very, very worth listening to. In the context of the fact that his beliefs probably reflect the beliefs of the big thinkers, the ruling class in this country, except that he's probably more philosophically aligned to you and I, which from my viewpoint makes him particularly interesting. He said, as an example, that the beliefs that he held in the 1960s as part of Ayn Rand's inner circle hadn't changed until today. What changed was his job description. He went from being a university professor and a forecaster to running the Fed. And he had to temper his beliefs in the context of his actions because of the requirement of his job. I'm paraphrasing him, but I found that to be an interesting point. A second point that he made is the idea that the Fed isn't politicized is silly. Naive were the words that he used. And so while what the investing public believes is that you have this independent Fed, nothing, according to Greenspan, could be further from the truth. Another point he made that really supports the gold thesis, I think, is that the Fed doesn't exist to defend the currency. The Fed exists to defend the banking system, which is a very, very different set of circumstances. As we saw in 2008, defending the currency and defending the banking systems are often antithetical to each other. Greenspan further said two things that I think were useful to our audience. When asked about the direction, the specific direction of both gold and interest rates, he responded first by saying that he had made his living as a forecaster for 35 years. And as a consequence of that, he was very experienced at obfuscation, which I found amusing. But the second thing he said, when pinned down with regards to the direction of interest rates, measurably higher. With response to the direction of the gold price, measurably higher. And he said that in the context of the fact that in his belief, in a representative democracy that exists wrapped around a welfare state, the demand for goods and services from the state will always exceed the demand for a sound currency. And that the profligacy that we have experienced in the U.S. is set not merely to continue, but in fact to accelerate. He didn't say it in those words, but when he said that a sound currency is incompatible with a representative democracy servicing a welfare state, you understand something about the volatility of change.
Rick, another question on that conference. One of the things I noticed in terms of the attendance, outside of it being very light, was the median age, which looked like to be about 65. And I mentioned to one of my colleagues there that I felt like I was a kid in high school again because of that age difference. And when you see that that accelerated age, if you will, is there a significance there to you in your mind? Is it just the fact that they have all the money? Or does it mean something else as well?
I think I have three significant comments to that. First of all, most of the people that are viewing this video will envy your viewpoint. That is to the future. Youth is a very good thing. Don't waste it. The second thing is that it's pretty obvious why the audience was so old. The audience that's attracted to hard money themes or natural resource themes are audiences that came into their investing prime during the decade of the 1970s, when the gold ran from $35 an ounce to $850 an ounce. The audience began to get a little younger. It's hard to believe that the audience you saw was a little younger, but it was. In the beginning of the last decade, when the narrative associated with resources became supported by the rise in emerging and frontier markets, and the sector became popular. I fully believe that two things happen over the course of the next decade. One, that the discussion that you and I are having with regards to resources, which is not uniformly popular now, will become uniformly popular as a consequence of the performance of those markets. And two, that as the performance of those markets accelerates, attention being paid by younger observers to that narrative will increase, because people's expectation of the future is set by their experience in the immediate past. Investors who are less forward-thinking than you, but who are of your same age, haven't explored the topic of natural resources and precious metals because they're more caught up in lifestyle topics, they're more caught up in technology investments, they're caught up in narratives that have been more relevant to them. If the copper price doubles, or if the oil price doubles, or if the gold price doubles, if the importance of the narrative becomes dramatically reinforced in their own experience, the number of participants, the number of people listening to discussions like this will increase, and their median age will decrease radically.
Rick, in the few conferences I've been to over the last year, I've been hit with a question, and that is for the person watching, if they're a current client of Sprott, or if they're thinking about becoming a client, where does their confidence come from that the next generation of Sprott will be able to carry forward the mandate that we've given to individuals, institutions, and nations to safeguard their assets in natural resources and do it in an efficient manner? When you walk down the halls here, up the halls at Sprott Global and at Sprott Inc., what are the encouraging signs that you're seeing from this next generation?
That's a wonderful question. The first thing is that there is a culture at Sprott. We are a financial services firm that isn't over-leveraged. We aren't run like an investment bank that has an 8% equity slice. We have a 100% equity slice. And people who are attracted to Sprott are attracted to Sprott via the culture. We don't think the culture will change. The second thing that happens is that young people who were attracted to Sprott and the Sprott culture are instinctively contrarian, or else they'd be going to work for one of the technology underwriters. They wouldn't be coming to work here. It is who we are and what we do that attracts these people, which is your first line of guarantee that these are hardworking, contrarian people who are willing to invest in their future as opposed to generate capital to consume right this very instant. The third thing is much more general, and it's interesting, I guess, when you hit my age, that the sort of collective wisdom is that the generation or two coming up behind you is somehow less worthy. I suspect that that was the feelings of our parents and our grandparents, and while it may have been true, it's important to note, when I visit with people my own age and they suggest that the younger people are less motivated or less well educated, I look at them and laugh and say, you know, you ought to come to work with me, either in Toronto or in San Diego. The truth is, when I look at the education, the motivation, the maturity of the 30-year-olds that work at Sprott, and I compare it to where I was at 30, I'm mightily impressed. And the idea that the generation, at least the upcoming generation in Sprott, is somehow some standard is laughable. It doesn't even merit consideration.
What's your prediction on gold prices over
Higher.
the next 3 to 5 years?
I think I'd have to echo Greenspan in that regard. I'm not really in the predictions business. I'm in the net present value business. And I would start in the context of net present value by saying I personally, as a speculator, sleep better owning it than not. But in answer to your question, I think for all of the reasons that Greenspan enunciated, that the gold price goes higher. Listen, from my point of view, on the gold side, we're simply locked in a war with the U.S. 10-year note. If the dollar strengthens, it weakens gold. If the dollar weakens, it strengthens gold. And I suspect that arithmetically, we're locked in a war that we can't help but win. The value proposition offered up by the U.S. 10-year Treasury is, if you believe their numbers, you give them $100,000. And in 10 years, they give you back $100 million in purchasing power. In other words, the best case is you make no money. The worst case, not the worst case, the mid case, for me, the appropriate case, is that if you give them $100,000, given the decline in the purchasing power of the basket of goods and services that you and I consume, not the CPI, you give them $100,000 and they give you back $50,000. Now think about that. The promise is that they deprive you of half of your purchasing power over 10 years. If the fight then is between gold and the U.S. 10-year Treasury, I don't see how over 5 years we can possibly lose that fight.
As a final question, is there anything you think we may have missed?
I think that's plenty for people to absorb in one conversation. I do think we need to have these conversations more frequently. I think they're valuable and they're also pleasant.
Rick Rule, Chairman of Sprott U.S. Holdings, thanks for sharing your comments with us.
Thank you, Takoa.